All right, we'll get started. Welcome to webinar on structured notes and why structured notes are currently better, and I think way better than your typical 60-40 portfolio. Actually, I've been thinking about this. I think that right now, if you own a 60-40 portfolio or even 80-20, that is 60% stocks, 40% bonds, or 80% stocks, 20% bonds. I think that right now could be the most important and biggest opportunity that you have with your portfolio in a way that could change your children's lives in the way of multiplying, whatever wealth you're going to leave to your children or your charities by, I don't know, double, triple, quadruple, probably closer to triple or quadruple. And that's how powerful I think the structured notes are in the current environment and their ability to help us transition into and modify our investment strategy to reflect current markets and future markets. So, first and foremost, what is a structured note? And by the way, okay, so I'm Sean Jones. I am the owner, operator, principal of Jones Fiduciary Wealth Management. Later on, I'm going to get into why you might care about that and my fiduciary arrangement with my clients. But right now, let's just dive into structured notes. A structured note is really just a custom bond. It's actually a hybrid bond, and it has two components. It's got the bond component, and it's got the derivative component, basically options. And so a structured bond or custom bond or hybrid bond is issued by the same entity that issues the normal bonds that an entity is always issuing. So if it's JP Morgan Chase, they have an entity that they issue all their bonds out of, and that's also who issues their structured notes. So when you have a hybrid like this, it causes these debt instruments to act much more like stocks than bonds. But they have a protection feature and some sort of yield or growth feature. And there's all different types of structured notes. I mean, if you can think of it, you could structure it, especially when we get into the custom note territory, which is where I tend to take my clients because you get the best pricing and it's current pricing. And so a structured note, just keep in mind, it's basically just a custom bond issued by all the banks that you have become household names. And before I get into why and how I think structured notes should be used, I'm going to talk a little bit about risk. And what I have figured out is that risk is something that nobody understands. And I say that without really fear of fear of error. I'm going to go through all of this later. And so when I look at risk, you look at, okay, let's look at your typical 60-40 portfolio. That is down 60% stocks, 40% bonds. That is down 20% year to date, 2022 year to date. So how can that be? That can be because people don't understand risk. If this was a participatory webinar, I would ask a bunch of people to say, okay, define risk for me. What I'll say is if you were in my office and you were asking me, how much risk does this portfolio have? I would like to know what you think that means. What are you asking me? Most people are going to say, well, how likely is it that I'm going to lose my money? That's not what risk means. And actually, there is no mechanism in the investment industry to measure how likely you are to lose your money. And the reality is, if you're investing, if you're putting money into a portfolio, how likely is it that your portfolio will lose money from one day to the next ever? 100%. I mean, there are going to be days that you lose money. And so that's 100% probability. I would say on the flip side of that, what is the probability that you invest money for 20 years and lose money? The probability is zero. You're not going to lose money. That has never happened. And so, well, I should say that has never happened with any of the major domestic indices or anything that someone might think of if you ask them what the market is. S&P 500, Dow Jones Industrial Average, NASDAQ. And so the term risk is just widely misinterpreted. And I believe that it is the place where the investment industry and investors decouple. In other words, that is where the disconnect is. The disconnect is in the understanding and the misuse of the word risk. And so I'm going to attempt to explain how the industry uses risk in a way to protect themselves rather than you. So if you were coming into my office and you were going to ask me to invest money for you, and I was your everyday advisor throughout history, what I'm going to do is I'm going to give you a risk tolerance questionnaire. And based on that risk tolerance questionnaire, I am going to decide how to invest your money. And basically, I'm going to decide how much of your money am I going to invest in bonds. The reality is that financial advisors don't invest in bonds. I just took a quick survey this morning. I ask people all the time. I ask all my friends. Every time I talk to an advisor, I ask them how much of their money they have in bonds. And the answer is 0 or maybe 10%. And I ask them how much of their client money is in bonds. And they'll say 30 to 40%. And that has, I shouldn't say always struck me. It didn't strike me as odd up until 5 years ago, and which was the beginning of me starting my own firm. But if all financial advisors at all ages don't invest in bonds, why are they investing their clients' money in bonds? And the answer is to protect themselves. So if you think of what a risk tolerance questionnaire does, it gives the advisor an answer as to how to invest your money. And then you can never sue that person, because if you say, okay, well, this is your risk tolerance questionnaire, this is how I invested your money, it's not my fault that you lost money. And that's true, it's not their fault. But it's really just a mechanism there to protect them. It's not helping you. And I'll tell you why. This is a 60-40 portfolio starting back in 2007, basically at the peak in 2007. So you can see that they had differing degrees of value, but basically by the time 2009 started, they were all starting in the same place. Now, this yellow line is the S&P 500, which S&P 500 is not a diversified portfolio. Well, it's diversified amongst large cap domestic companies, but it's not the only investments I would want you to invest in, even if you're going to be 100% invested in stocks. So just to look at this though, the S&P 500, by the time 2021 rolled around, is so much more valuable than a 60-40 portfolio that you're never going to go back to wanting to be in that portfolio. Here's what I mean is, okay, the reason that most people are in a 60-40 portfolio is so that they can withstand the risk. Well, the risk is nothing other than volatility. When an advisor or the investment industry says that they're reducing your risk, all they're doing is reducing the amount you're going to lose from, 1% today, each day to 0.75% each day. You're not going to perceive that difference. Okay, you would be down 35% instead of 52% in the two worst case scenarios that we'll look at. That's how much you were down in the worst case scenario. But why are you caring how much you're down in the worst case scenario? that's going to be maybe 6 months out of a 10-year sequence. You might experience that downtime 6 months out of 10 years. And that's only ever happened three times in history anyway. Most of our downturns are 30%, and you're going to be down 24%. Are you really going to notice a difference there? So look at this S&P 500. If I had invested here in the S&P 500, okay, there was a point in time here early on in 2011 where I was back down to having the same amount as a 60-40 portfolio. Maybe an 80-20 portfolio had a little more, but basically 60-40 and 80-20 were pretty much in the same place. Then forevermore, no matter how bad the markets have gotten, I never again wished I was in a 60-40 portfolio or really an 80-20 portfolio, because look what happened here. During COVID in 2020, S&P fell more than all the others, but it's starting from so much higher that the worst case scenario in the S&P 500 is still just as good as the best case scenario in a 60-40 portfolio. And it's still not as bad as the worst case scenario in an 80-20 portfolio. What I'm saying is once you get out of the woods and you hold stocks long enough, you are never going to go back to wishing you held bonds. And people will say, well, okay, well, what about when I retire? I don't want to have to sell when I'm down. Well, first of all, you won't have to. I mean, even if you don't have any ability to make a strategy, you could just say, all right, well, I'm going to put 3 years of my spending needs in cash and put the other 80, so that's 15% of your portfolio. So I'll put the other 85% into the S&P 500 or some other stock portfolio. It's not going to matter how much you're selling in a down market right here to meet your needs for that 1 year. And by the way, it was only down that long for 3 months. Usually it's down that long at most for 4 months, 5 months. You've got 6 months cash on hand for sure. But anyway, let's just say you had to sell at the worst time. It doesn't matter really how much you need to sell. Selling off 5% of your portfolio while it's down like this is not going to put you back down to where you would have been if you had a 60-40 portfolio. So anyway, I don't believe in investing clients' money in bonds. I believe in managing their income needs with cash preservation and cash management. But there are other instruments, okay, so structured notes may come into play, but I've never really used those until right now because they're structured so well. So right now, for those of you who are in this 60-40 portfolio and you're hearing what I'm saying and saying, yeah, I want to invest like an advisor invests, and I want to have the most wealth over time, regardless of income needs. I want to transition from my bonds into stocks, which, by the way, if you have a portfolio that is automatically rebalancing, you've already done that a couple times this year. Your portfolio automatically has sold bonds and bought into small cap companies if you have a diversified portfolio. So you're already doing that a little bit. It is scary, I will admit. We're only down 20% right now with the S&P 500. We are also down 20% right now in 2022 on a 60-40 portfolio. Transitioning from giving up those bonds to go into stocks is a scary thing. I understand that. Forget the fact that if you had always transitioned at any time, anywhere in history, transitioned from stocks to bonds when the market was only 20% down, you would have increased your return by unbelievable amounts, especially when you look at how much that will compound over 30 years. So forget that it's already a good time to buy. Here's where structured notes come into play. We can protect you from the next 20% of the down market while transitioning from your bonds into the stock market via a structured note where you are protected from the first 20% of the downside and you are participating in the next 100% of the upside. I'm going to go through that in more detail, but for my clients this year that have done this, first of all, they're already extremely happy. They understand the value of it, but they are never going to go back. They are going to see this as the best decision they ever made investing. They are. There's no chance that they won't. And as long as we're looking at it on a, 10, 15, 20-year time horizon, this will be the best decision they've ever made. All right, so going back into looking at a 60-40 portfolio. 60-40 portfolio is 20% down so far in the year 2020. The worst, I know that's kind of hard to see, but the worst it has been down recently is 26.5%, and that was in 2019. For some context, the S&P 500 was down about 35% during that time. In 2008, the 60-40 portfolio was also down 26.5%. Now, the S&P is down 20%. Your portfolio is down 20. A 60-40 portfolio is down 20. Let's just say worst case scenario is going to be you're going to lose another 6.5% if the market continues to go down, which I think it probably will. You stand to lose another 6.5% inside your 60-40 portfolio. S&P 500 is down 22% probably as of right now. And I want to point out that worst case scenarios in the S&P, let's see, I can make this smaller. Worst case scenario in the S&P has been 56.8%. And I don't even think that was intraday. I mean, I don't even think that was the closing. It didn't close that low. I believe it closed down about 51% that day from the height of the previous year. But let's just say 56% was worst case scenario. The worst case scenario at any other time was 49 and 48. 49 and 48. So that means that if I own a structured note that protects me from the next 20% downside when I'm already down 22%, it's going to protect me so that I don't lose money until the market loses more than 42%, which means here I'm going to be down 7%. Here I'm going to be down 6.2%. Here I'm going to be down 10%. 15%. So yes, we do have potentially some significant, or not even significant, but downside. Remember, our 60-40 portfolio, we're assuming it can be down another 6.5%. Well, here we're basically the same in these two scenarios and a little bit worse in this scenario, another 10% in this scenario, actually 14 or 12% in this scenario. But look at these other numbers. This is the S&P 500 worst from peak to trough. Only 3 of them are anywhere near 50%. Next is 2 times it lost 35%. Most of the time it's down 20, 28, 22, 27, 19. But let's just say worst case scenarios, we're going to lose something like 8% in our portfolio. And that's like in the worst case scenario. But the way these structured notes work is that they are on a 2 or 3 year time horizon. That even in these worst case scenarios where the market was down 56%, it doesn't stay down that long. It stays down there maybe 3 months, 4 months. It does not like to stay down those losses. You know why? Because the people that know what they're doing come in and they buy it up so quick that it just cannot stay down there. Look how steep these markets are in and out of here versus how long it takes it to get from here to here is so steep, and then it is less steep from here to here. And so it just does not stay down that long. And these structured notes are 3 year notes. The chances that you will still be down more than 42% 3 years from now is, statistically speaking, like none, almost none. Not saying it can't happen, but it has never happened, put it that way. Doesn't mean it can't happen, but based on history, the likelihood is 0. And so when I look at this and I say, okay, well, I can invest in a structured note where the most I'm going to be down, most likely, is going to be, in this scenario, 14% is what I'm going to lose. I'm going to lose 6.5% in my 60/40 portfolio, because rest assured that if the market is down another 36% from where it is now, your 60/40 portfolio is going to be down more than 6.5%. It is. But let's just say it's only going to be down 6.5% compared to, in this scenario, we're going to be down 16%. Okay, fine. It's 10 more percent, and you're down that long for 6 months. Going forward, though, look at the upside. The 60/40 portfolio has no upside. I mean, it does. It's better than just being in bonds completely, but you're just giving up so much upside for risk mitigation, and it's not mitigating you from the risk that you think it's mitigating you from. So I would like to encourage my clients and my, prospects to think of this as an opportunity to stop investing the way that some risk tolerance questionnaire suggests that you should invest, and start investing like an advisor. And by the way, look up, are risk tolerance questionnaires effective? Are risk tolerance questionnaires accurate? Something like that. There's so much evidence that says they're not, and of course they're not. It's 10 or 12 questions. And by the way, if I give you that risk tolerance questionnaire every single month and then adjust your portfolio every single month by your answers, you are going to underperform the market. That portfolio will change in exactly the wrong way at exactly the wrong time, because it is way better at measuring your fear and your misunderstanding of the market than it is at measuring your risk tolerance. And your risk tolerance will change according to those questionnaires every month, every 6 months. When the market is at its highs, your answers will be different than the markets are at its lows. Well, that doesn't measure your risk tolerance. That's not measuring your true long-term risk tolerance, and we're building a long-term portfolio. So anyway, I encourage you to take a look at these buffered notes. So let's just clarify what it is that I said there. Buffered note, the buffer describes the protection you get on the downside. So if we're talking about the S&P, and the S&P 500 is down 10%, you're going to be down 0. If the S&P is down 20%, you're going to be down 0. If the S&P is down 30%, you're going to be down 10. So you only lose percent for percent after the buffer. On the upside, okay, so there's the buffer, right? So the downside, market's down 1, you're down 0. Down 2, you're down 0. 3, down 0. Down 20 is right here. Now you're down 0. Down 21, now you're down 1. But on the upside, because this is a 3-year note, there's hardly any chance we will be on this side of this graph in 3 years. On the upside, you can either get 100% participation with a certain cap, you can get 120% participation with a lower cap, you can get less than 100% participation with a higher cap. So there's all different ways you can do it. But basically, the ones that I like are the ones that you get 1-to-1 on the upside or better. So if the market's up 10, you get 10. Market's up 20, you get 20. Market's up 30, you get 30. And right now, and typically 50, 60% is where the cap happens. Right now, the pricing is such that you are going to get capped around 100%. That means the most you can do is double your money in 3 years. Again, that's never happened. So what that means is the caps that are currently being priced are virtually not caps. I mean, it's uncapped. It's in a cap that you would never have hit in the past, and there's no reason to think you'll hit it now. Even if you do hit it, though, are you really going to be that upset if you have a 100% rate of return over the next 3 years, especially since you're trading out of a bond where there's 0 chance you're going to have a 100% rate of return? You can't even have 30% participation or 30% rate of return over 3 years, most likely. And so that is what the trade-off is. Here's the catch. You do not get dividends in structured notes. So right now in the S&P 500, the dividend payout is somewhere around 1.5, 1.6, something like that. Let's just say it's 1.75%. Let's just say it's 2%. Over the next 3 years, you give up 6% on the upside. So instead of getting a 50% rate of return, you get 56% rate of return. that is still way better than the return you are giving up by investing in a bond right now. And so, and for the confidence it's giving you to transition your investment strategy into stocks or more into stocks. And so I believe that the 6% you're trading in dividends for the 20% downside buffer is such an outweighed and oblong trade-off that right now, we would look at right now as a time that is unlike any other when we look back on this time. 30 years from now, we're going to see this as an obvious place where we should have transitioned. And we could, especially if we are going to use structured notes as a way to improve our confidence in converting over. So just to recap, I don't know if this is really any more clear, but if we buy a note here and the market goes down 20%, we don't start losing until it's 20%. We go up 1 for 1 until 100% cap. The market may keep going, but we're going to be capped at 100% after that 3 years. All right, I know I was going to get this question today, so I put it in here. What about Treasury, or what about inflation-protected notes? Well, this is how the inflation-protected notes have fared so far in the past year. And I don't have time to go into why they can lose value when they're paying out something like 9.5% right now. But the answer is because rates are still increasing and it still affects their principal. The 9.5% is just the coupon bond. Now, again, this is just the pricing. All right, so it's down from 114 down to 94. So, you know, we lost 20 points on 114. That's something like a maybe, I don't know, 15% loss over a year. So we lost 15% and we earned 9.5 back of that in coupon payments. Not terrible, but we still lost money. So there's all different types of ways to skin this cat. I don't think that owning bonds is one of them. Now, you might say, Sean, I'm in a 60-40 portfolio. I see what you're saying, but it's just a little concerning to completely change my investment strategy. That's okay. I have clients today that did not start transitioning and do it all at once. I have clients that did do it all at once. I have clients that did it during 2020 without structured notes because the pricing wasn't there. They just did it bare, the old-fashioned way, sell bonds and buy stocks. I have some that did a little bit then, and they did a little bit in the meantime, and now they're doing the rest now. I have some that are just starting now. But the point is that over time, you want to invest like an advisor, not like someone that took a risk tolerance questionnaire. Okay, so I'm sure I'll get lots of questions in reply to that. Hopefully that makes sense to you. I'm going to give you a little bit of information on why should you care what I think. Well, I've been in this industry for 22 years giving advice directly to clients, and about 10 years ago I started seeing things in the industry that I thought did not make sense. They seemed like just parroting as opposed to intelligence and research. And so I wrote a book in 2017, finally published that in 2021. I also started my own firm in 2021. And all of these things are based on me seeing what I think is wrong in the industry and structuring my practice to either head a different direction, circumvent those small pieces of the industry that I didn't like or didn't think made any sense. But I could not do that at my previous firm. And so this firm is based on the mantra of using 75 years of research to make investment decisions. And one of the things that I do in my practice is that I do not invest clients' money in anything that I am not also investing in. In other words, basically what I figure out is what I think is the best place to put my money based on research. It's not speculative at all. It's based on long-term trends. What is the best way to make the most wealth over long periods of time? And that is how I invest my money, and that is how I encourage my clients to invest their money. But I walk the walk 100% of my net worth. I would say 99% of my net worth. So when I started this practice, I wanted to go direct to investments. I didn't want to hire money managers outside. I didn't want to hire, a broker dealer to scrutinize my advertising practices. I wanted to be able to say what I think is the truth all the time and have my clients and I have a direct relationship, cut out all the middlemen, cut out all their fees. And so because of that, I was able to cut out 20 to 30% of my clients' fees right off the bat. And I want it to be a transparent fee structure. I want it to be better to access all the information so that everything is in one place so that clients don't have to log in to 6 different things to find out what their different investments are doing. That's not super easy to do. And so I think my clients now are down to 2 logins. But it's an important because we had 5 or 6 logins at the previous firm. There's a sophisticated execution of investment strategies. What I mean by that is that we have smart allocation based on that 75 years of research. We've got the automatic year-round tax loss harvesting. What we did at the previous firm was, if we ever did it, we would look at the end of the year and see if there were any losses that we could harvest. Well, that's nice, and that's because it's difficult to do on a manual basis. But now I have a program that goes in every single day and measures the losses, if there are some, rebalances, and picks up those tax losses so that we can reduce the overall taxes that are paid on capital gains. Smart rebalancing adds up to another 1%, and tax optimization adds up to 2.5%. If you're in the highest tax brackets. I do have an option strategy platform, which I have, which is still running. Right now, the structured notes are doing the same thing as the option strategy, but with the structured note pricing the way it is, it's just more simple to go direct to the structured notes. And so that's an example of where I don't try to boost up my own platform. I see what's best for me and my clients, and we go there directly. And so that's what the access to the structured notes direct is all about. All of this is with no commissions and with a fiduciary responsibility to all of my clients. This is in here from my real estate fund. And so when you look at how Jones Fiduciary Wealth Management is structured, it is structured in a way to where we invest your money the way you would invest your money if you knew as much as a financial advisor knows. It doesn't mean we're going to invest exactly the same as I invest, because at the end of the day, I'm not retiring, tomorrow. I'm not retiring in 5 years. I'm not retiring in 10 years. So there are small differences there. But the point is, regardless of those things, if you knew as much as me, you would still not own 40% in bonds. I don't care what part of your life cycle you are in. And that goes with all the different points in my career or your life cycle. We just want to find the best way to grow your money and to meet your needs and to deliver the income that you need so that you can spend what you want without having to worry about where it's coming from. And we're going to find the best way to do that. And I would say at the lowest cost. So if you have questions on the structured notes based on, some of the things that I've said today, obviously you can reply to the email that this replay is on. You can give me a call, go to my website. There's a number of different ways that you can bone up on the different strategies. If you're interested in having a discussion, I treat every initial discussion as an informal chat. There's no way that you can know that you want to do business with me or that I want to do business with you over a first phone call. It's just not going to happen. I do not want to pick up clients after one conversation, and you do not want to pick up an advisor after one conversation. And so I would suggest that we have an informal chat, see what's going on there. If I can't make an improvement over what you're doing, I have no interest in trying to tell you I can make an improvement, because there's no way I can live up to that promise. I had a conversation this morning, literally right before I got on this recording, and they wanted to know if they should log into the structured note webinar. I asked them, I don't know, it might have been 4 or 5 questions over, probably took 45 seconds. And I told them, don't log on. It's not going to help them. It's not relevant to them. And they didn't own bonds. They didn't have cash sitting on the sideline. And they were thankful that we just got off the phone. So that's the way we operate. Again, thanks for tuning in. I appreciate that there's lots of stuff we all got to be spending our time on these days. And so tuning into something like this is pretty a big deal. So I think you'll find that you agree with this opportunity in the structured notes market, and let's continue that conversation. Thanks.